Hey guys, welcome back to My Financial Focus. In this video, I want to do an intrinsic value analysis of Chipotle Mexican Grill. Right here, we can see that in the last year, their share price has declined a little bit, and some analysts on Wall Street believe that this could present a good buying opportunity. So I'm just going to figure out what the business actually does, how they produce revenue. I'm going to go into their annual report to get a better understanding of the financial health of the business. And then lastly, I'm going to do a discounted cash flow analysis using this model that I built in Excel. And this is just going to show us based on some assumptions in the growth rate as well as some of the cash that's currently on their balance sheet as to what a good buying price would be for us from a value investing perspective. So thanks in advance for leaving a like. If we could get this video to 10 likes, that would be awesome. So let's get right into it. Right here, we can see that this is their menu. They own and operate about 2,724 restaurants in the United States alone, and they own and operate about 40 restaurants internationally. They sell everything from like burritos, burrito bowls, tacos to different varieties of salads. And they opened their first restaurant in 1993 and then just started building more and more all across America and also internationally. And they also employ about 88,000 people worldwide. In their annual report, the first thing that I want to look at is some of the risks that are facing Chipotle as of right now that might affect their growth into the future. And obviously, from a value investing perspective, we want to know about the risks too if we're going to be investing in Chipotle long term. So the first risk that I want to point out, just two main risks that caught my eye, was this one right here, which points out that in 2020, 46.2% of their revenues came from digital orders, which is up from 18% of their revenues in 2019. So almost 50% of their revenues came from digital orders. And unfortunately, because of their current business model, some of the deliveries that they made were actually unprofitable because the delivery fee that they collected from their customers was less than the cost of the actual delivery. And so in that case, it was unprofitable. So if they continue at this rate with some of these unprofitable deliveries, that could obviously negatively impact their profits long term. And then the last risk that I want to point out here is that some of the labor shortages in the global supply chain right now are leading to cost push inflation. And what that basically means is that there aren't enough goods being produced, or in this case, ingredients like beef, avocados, chicken, and things of that nature. And so because the demand is staying constant, but the supply is decreasing, that could increase prices, which would increase their operating expenses, which would obviously eat into their bottom line and their profits. The next page I want to look at is page 33, and this is the first page that points out one of their financial statements. This is their balance sheet, and right here we can see that the cash and cash equivalents on their balance sheet as of 2020 came out to be about $600 million. And that makes up about half of their total current assets at $1.4 billion in 2020. And then their total assets come out to be about $5.9 billion, up from $5.1 billion in 2019. So they're definitely growing their business and expanding internationally. Right here, we can see that their total liabilities came out in 2020 to be about $3.9 billion. Most of that just coming from long-term operating leases for their restaurants. And then their retained earnings come out to be about $3.2 billion, which is up from $2.9 billion in 2019. And their total shareholders' equity has almost increased by about 20 to 30% from $1.6 billion to $2 billion. On the next page, we can see their income statement. And just a couple of facts about their income statement, as we can see, is their total revenue increased by about 7.1% to $6 billion in 2020, up from $5.6 billion in 2019. Also, during 2020, their operating costs were pretty extensive. We can see that their total revenue was $5.9 billion, and their total operating expenses, including things like labor, packaging of food, as well as delivery expenses, came out to be $5.6 billion. So that's about 82% of their total revenues is just going into operating their business, and that's up from 79% in 2019. And that mainly came as a result of an increase in the price of ingredients like beef, for example, as well as the fact that they had less beverage sales than they had anticipated they would have if the global pandemic hadn't negatively impacted their business. And then right here we can see their consolidated statement of shareholders' equity. And we can see that the increase in shareholders' equity came as a result of the retained earnings that they had in 2020. They retained about $355 million of earnings, which added to their total retained earnings of $3.2 billion, increasing their total shareholders' equity. And then right here, we can see their cash flow statement. And we can see that the net cash provided by their operating activities in 2020 actually decreased from 2019, mainly as a result of the lockdowns that went into place that affected their retail stores. And then right here, they used about $432 million in investing activities, much of which just went from purchases of investments, probably shares in other businesses, or maybe even like retail and investing in different new stores and things like that. And then right here, lastly, we see their financing activities, which came out to be a negative $104 million, which mainly came from acquisition of treasury stock as well as tax withholding on stock-based compensation awards. So their cash and cash equivalents at the end of the year increased from about $508 million to $635 million. So the next thing that I want to do is the cash flow analysis, a discounted cash flow analysis. And how I'm going to do that is just by using this discounted cash flow model that I built in Excel. And this is just going to give us a better understanding of the intrinsic value per share of the business, so we can know if buying in at like $1,500 per share is a good price to buy in, because Warren Buffett and different value investors do stuff like this all the time. So let me just demonstrate how this works. So the growth rate for years 1 through 5, I'm just going to use a value that I got off Yahoo Finance right here for the next 5 years. Analysts predict that the growth rate for Chipotle might be around 44.64%. And that is a pretty large growth rate, so I'm not too sure how accurate that is. But obviously, one of the limitations with a model like this is that there are a lot of assumptions that go into it. So it might not be perfect, but it is a good model that we can use to reference when we're trying to figure out the intrinsic value of a business. For the next years 6 through 10, I'm just going to be conservative and say that they'll grow at half the rate that they'll grow at for years 1 through 5. For the year 1 free cash flow, I got that from TradingView just by going to the cash flow section and then scrolling down, and we can see that their cash flow for the trailing 12 months came out to be about $703 million. The net cash minus net debt I got from Yahoo Finance just by scrolling down, and we see right here that it's about $1 billion minus $3.49 billion, which comes out to a negative $2.47 billion at the start of our analysis. Their stock ticker is CMG, and then shares outstanding came out to be about 28.14 million shares. And so after we plug in those values, we get the projected cash flows that the business will produce for the next 10 years, as well as what we would theoretically sell the business for in year 10, which is 10 times year 10's free cash flow. And then we're just discounting those values back by a discount rate of 10%. And we can see that after adding these values together, the present value of the future cash flows comes out to be about $47 billion, with the intrinsic value after we subtract the debt that's on the business at the start of the analysis coming out to be $45 billion. And then the intrinsic value per share based on these growth rates comes out to be about $1,617 per share, with a 30% margin of safety of $1,132 per share and a 50% margin of safety of $800 per share. And compared to the current share price, that would put Chipotle at a bit of an undervaluation at the moment, just because we can see that the intrinsic value per share is $1,600, whereas the share price is currently trading at about $1,500. So based on that, it would seem that Chipotle does potentially present a good buying opportunity at the moment based on these growth rates. But as I said before, a discounted cash flow model isn't entirely perfect. It's just a model that we can use to reference when we're trying to figure out what the value of a business is. But based on this model and these assumptions, it seems like Chipotle could possibly present a good buying opportunity like these analysts say. But I would definitely love to know what everybody in the comments thinks, if they think that Chipotle is a good buying opportunity at the moment, or if they're going to wait off a little bit and wait for the share price to drop lower, or if they're going to invest in anything else. Definitely let me know. Leave a like on the video, comment, subscribe, all that good stuff, and I'll see everyone in the next video.